Analyze portfolio correlations is finance software for a specific operational decision. Examines cross-asset correlations to identify trading opportunities and manage portfolio risk across equities, FX, and derivatives. This video explains what the tool does, why the workflow matters, and how the output becomes useful decision evidence. The problem is that finance teams often manage this workflow with scattered inputs, inconsistent review rules, and manual interpretation. At quarantadue.ai, every MCP workflow starts from the real tool interface, not from a generic prompt. The goal is simple. Keep the expert in control while the system structures the evidence. Inputs, reasoning, and outputs stay connected in one reviewable flow. Now the results become easier to compare, easier to review, and easier to explain. Analyze portfolio correlations narrows that process into a repeatable model so teams can compare cases without rebuilding the logic each time. Analyze portfolio correlations starts with a defined input contract. Typical inputs include equity returns, FX returns, derivative Vegas, look-back period, and confidence interval. Keeping these fields explicit reduces ambiguity and makes every run easier to audit. The workflow then applies calculate the correlation matrix by computing Pearson correlation coefficients between each pair of asset returns, equity, FX, and derivative Vega changes over the specified look-back period. Perform principal component analysis on the correlation matrix to determine the percentage of variance explained by each principal component, sorted in descending order. Calculate the portfolio diversification score based on the average absolute correlation, where a higher score indicates better diversification. Test the statistical significance of each correlation coefficient using a t-test with the specified confidence interval and look-back period. And calculate optimal hedge ratios for asset pairs where the absolute correlation exceeds the minimum threshold, using beta coefficients derived from the correlation matrix. This keeps the process deterministic, reviewable, and aligned with how finance teams actually make decisions. Analyze portfolio correlations returns structured outputs such as diversification score, diversification risk level, correlation matrix heat map, variance explained by principal components, and optimal hedge ratios for correlated pairs. These outputs are designed to support review, reporting, comparison, and follow-up actions. The value of analyzed portfolio correlations is not just automation. It is a controlled way to turn repeated finance work into a documented business process with clear inputs, transparent logic, and reusable outputs.